I would like to talk about misperceptions on investment in Africa and how they relate to industrialization. The first misperception is that investment in Africa is not picking up like in other similar regions. Africa's trajectory is often compared with India, a country with slightly larger population than the continent and currently posting 7% annual growth. Conventional wisdom often holds that India is beating Africa in attracting investment. However, this has not been the case since 1970. Even though the lost decades of the 80s and the 90s, which characterized Africa, and the resurgence of India as a powerhouse around the turn of the century, Africa has invariably been receiving more FDI than India. Since the turn of the century, the differential in foreign direct investment between Africa and India has amounted to 53% in dollar terms and about 41% in GDP terms. Both Africa and India have experienced large increases in FDI in the first decade of the current century. But since 2008, Africa's FDI inflows have proved more stable than those of India. Foreign investors have been taking heart from Africa's improved business environment and regulation, relative macroeconomic stability, and strong economic growth. However, if Africa is really to become a new and lasting business and investment frontier, it needs to harness its most promising resource, its people. Africans are young, booming, increasingly better educated, healthier, and are expanding their disposable income. Africa's middle class is also growing. By 2025, Africa's population will surpass that of India and China. Both industrialized and emerging economies, including India and China, have already taken note of Africa's abundant labor supply and cost competitiveness. They are now integrating the continent into their global value chain by relocating labor-intensive activities into Africa, including in manufacturing. As countries such as India and China have rid themselves of this myth and look towards Africa as their own new frontier for FDI, they are relocating their manufacturing as well. A second misconception or myth is the high risks incurred when investing in Africa. When it comes to assessing investment risks in Africa, there remains a gap between real and perceived investment risks. According to the latest Africa Attractiveness Survey by Ernst & Young of this year, perception of risks by investors differs on whether they are operating or not in the continent. Africa is the most attractive investment destination in the world, with the majority of them, 66%, believing that the continent's attractiveness has improved over the past year, and 81% of them foreseeing improvements for the next 3 years. By contrast, for the group of investors that are not established in the continent, Africa is the second attractive destination, with only 30% of them believing the continent's attractiveness has improved over the past year, and half of them expecting attractiveness to be improved over the next 3 years. These figures indicate that on the one hand, overall perceptions are still influenced by outdated negative images of Africa, but on the other hand, they can be corrected by making the initial step of setting up business in the continent. Some other key underlying factors of the diverging perception may include the fact that investors operating in Africa have a better understanding and assessment of the risk factors. By contrast, those who are not established might have been prevented to do so due to lack and sometimes information costs, exacerbated by the fact that the continent is fragmented into several small economies. In fact, when analyzing investment risk profiles worldwide, Africa does not appear to lag behind other regions that have attracted more investment. Indeed, recent figures from Euromoney country risk profiles suggest that African countries such as Botswana, Namibia, and South Africa share same risk levels with India, China, Turkey, Spain, Italy, Mexico, or Portugal. Furthermore, Ghana, Cote d'Ivoire, Tanzania, Tunisia, and Algeria are within the same country risk rating group as countries like Russia and Vietnam. More interestingly, Africa has proved to be more profitable for businesses compared to other regions. Research in the field corroborates that the average annual return on investment of firms operating in the continent was 65% to 70% higher than comparable figures for China, India, Indonesia, or Vietnam. In the same vein, FDI is being led by service sectors such as transport, electricity, gas and water, and construction, followed by manufacturing, such as motor vehicles, beverages, and food. The importance of FDI in services can be appreciated through greenfield investment flow data, where the sector accounted for the majority of the FDI projects into Africa and the largest single industry, amounting to 3.1 billion just in 2015. Investment into the sector is attracted by industrial policies being developed by countries such as Morocco, Ethiopia, Rwanda, and Cote d'Ivoire. Other factors such as the size of the urban consumer, improved infrastructure, as well as better market access through bilateral and regional trade agreements are making their mark. This represents a good linkages into the economy, especially as this industry, conditions allowing, has the potential to source intermediary inputs and services in the local market and could boost multinational enterprises' activities in the continent. The biased perception on the lion's share of investment flows to Africa is going to natural resources effectively implemented. In 2014, 88 billion of announced FDI was in natural resources sector, followed by services 37, and lastly manufacturing only 29. But the reality of the investments themselves is completely the opposite. This is in line with another misconception, that Africa's economy is based on the primary sector, showing immense potential in developing regional service sectors. Some countries have emerged as regional services hubs or leaders and are providing these to other African countries in sectors such as banking, telecom, and air transportation. This regional experiences is a platform for developing regional value chains and for linking in the financial sector. Is intra-regional, reflecting several factors driving and facilitating regional financial firms to expand on the continent rather than beyond. Equally, the rise of telecommunications FDI into the continent reflects greater affordability of smartphones, increased consumer spending, a push to expand broadband, 4G, and fiber optics in order to take advantage of these trends, and unsaturated markets with first mover advantage. Another important factor has been the disposal of cell phone towers by telecommunication companies. For example, of this push to advance connectivity, India's Bharti Group undertook 11 greenfield investment projects in Uganda and Nigeria in 2014 alone, into the Democratic Republic of Congo, Chad, Seychelles, Malawi, Tanzania, Ghana, Madagascar, Burkina Faso, Republic of Congo, Sierra Leone, Kenya, and Zambia as well, and is establishing Wi-Fi networks across 17 African countries. African investors have been prominent investors as well in the sector, with 31% of the global capital expenditure in this field coming from Africans themselves. A fourth myth that needs to be debunked relates to the low levels of domestic investment in the continent. Traditionally, domestic investment in Africa has been consistently low compared to other developing regions. For example, between 2000 and 2011, Africa registered 19% of domestic investment as a share of GDP, compared to the average in other developing economies of 26. However, these aggregate figures mask what a number of countries have experienced. For example, a few countries are way above the 25% mark. This is a laudable and positive development, which further tallies with another important trend in domestic investment. The continent has registered a considerable increase in productivity of capital in the last two decades, and most of it has come by the industrialization drive. Another notable trend that is fueling the domestic investment story is that inter-African investment is on the rise. It is increasingly being used to finance transboundary projects, notably in the sectors that face major binding constraints, energy and infrastructure. A successful example of this investment story is Dangote Group, an African industrial conglomerate that is harnessing the big growth opportunities in Africa. I understand Mr. Dangote was going to be with us. His expanding group is now aiming to reach 100 billion turnover by 2020. So what can be done to boost investment in Africa now that some of the myths and misconceptions have been debunked? It is important to understand that there is no silver bullet or magic recipe to attract investment. Some will argue that focusing on ease of doing business will improve the ability of a country to attract investment. I do not agree. There are countries in Africa which have managed to attract high rates of investment despite ranking low in the ease of doing business indicators. Take China, for example. Out of 190 countries that are ranked, it holds the 78th position. It is very far from the top 10 that make that ranking, yet it is among the top 3 most popular investment destinations worldwide. The explanation is simple. Size matters, and a number of other elements count as well. So we should not really discount the importance of easing business, but we should also bear in mind that it is a complex world and it is a competitive world. Investment in the agribusiness in particular is of critical importance to Namibia and to countries in Africa in general. And I would like to say that to diversify from traditional investment into the mining sector, into other sectors, this is probably the first entry point. In the case of Namibia, the country has experienced how sanitary and phytosanitary measures can pose an immense non-tariff barriers to its agricultural exports. The good news is that this has been addressed, and therefore now Namibia can, for instance, export its beef to the US and China. That shows that it is much more than just ease of doing business. These requirements often vary across markets, raising production costs and reducing any competitive margin the country may have over other producers. These barriers cannot be overcome without adequate investment to upgrade, acquire technological and innovation capacities, as well as adequate certification infrastructure that meets international standards. Another product which has experienced similar constraints in Namibia is certainly the one that relates to fishing. And I hope that this is going to be equally the subject of the same level of attention. Allow me to use my remaining time just to say one word. The dialogue on investments in the continent is now being prioritized at the highest level, and this forum is a good demonstration. It represents a unique opportunity to change the way in which the continent is perceived and as investment destination, but also by extension, how it attracts investments. I call upon all of you to be agents of change